Okay, I want to take a moment and thank everybody for listening to this call. I think it's going to, um, I think it's going to dispel maybe some rumors about stated income, specifically stated income for commercial or investment properties. Dispel some of the good, bad, and ugly rumors that are there. I have with me, I'll just call him Mr. X, but his name's Dave. Hello, Dave. How you doing?
Hi, how are you?
Good. Dave's been involved. I I think I've been in commercial lending for about 20 years, and I think stated income has been here off and on since the early 2000s. And you were involved with some of the big players back in the early 2000s. Is that correct?
Yeah, that's correct. I started with one of the big lenders that started the stated income loans for commercial back in 2001, and had a time period where I stepped away. Well, I think we all stepped away from stated income on the commercial loans, and we're back at it again. So,
Gotcha. You know, there's some I would just like to call them misperception or misconception about stated income, because when you look and do some research about it, sometimes you'll see them referred to as liar loans. And in reality, weren't they really referring to the residential loans where you could just put on the residential 1003 app what you earned, and that's why they call them a liar loan?
yeah, what happened was there was stated income came about as a need for a specific niche of the market. Maybe mainly the self-employed, small business owners, people who had major income off rental property, borrowers typically like that. Well, people started using their stated income loans and giving them to, you know, school teachers, police officers, people that were very much on a fixed income to get them to qualify to buy, bigger and bigger houses that, on paper, everyone knew what they made. And, you can simply do the math on these people and see, in the long term, they wouldn't be able to afford their mortgages. So I definitely think for a certain segment of the market, stated income loans are necessary and actually save them money, and many times to an alternative, which would be hard money. But I think there's a lot of liberty taken with stated income loans.
So in reality, you should try and avoid hard money at all cost, in my opinion. I mean, I'm finding out that hard money loans today are they're almost underwritten like conventional loans. You know, they're looking for, first of all, most of the places I know look for financials. Um, and once you start looking for financials, that's going to cut out. You might have, not all deals are created the same. If you've got bad financials on a site, it could be because they're poor money managers. It could be because a husband and wife are divorcing. It could be business partners don't get along. It could be a situation where maybe construction has gone on in the area and traffic has gone down. So not all bad financials are created equal, if you would agree.
Yeah, and I absolutely agree. If there's an alternative to going to hard money, you should absolutely look into it. In the past, you know, people for a lot of people the choice was qualify at the bank, and if you don't, you'd have to go the hard money route. Well, the stated income program can actually help a lot of those people that don't qualify at the banks, but we can get them qualified into a stated income loan where you know rates are a little bit higher than the banks, but a lot less than they would get with hard money. Same thing with points and fees; they're a lot less in the stated income segment of the market, and LTVs in terms are much more aggressive. We typically hard money you're looking at 50% max. With the stated income programs, you can go as high as 70, in some cases 75. And often with the hard money loans, you're looking at a 12-month term where it's kind of a band-aid loan, where it helps out with financing, but they need to get out of that hard money loan in a year, and a lot of times that isn't enough time to fix whatever problem the borrower got into that they had to go hard money in the first place. Whereas on the stated income loans, we can offer a 30-year AM with no balloon, so it could be a permanent fix for them.
Sure. Um, and I put a lot on our website a lot. You really shouldn't be punished for having good or great credit because in reality, uh, whether it's a bank loan or whether it's a hard money loan, if you've got somebody coming in with excellent credit, they're being punished because of something they might be buying that doesn't cash flow through no fault of their own, and yet they might be more adept at running it. They might be more qualified at running it. Some people are just better with their money than other people are too.
Yeah,
So
and let's be honest, some people purposely show that they run great businesses. They might run a cash business, and their tax returns looks like they aren't making money in their business, or they might structure like that purposely so they don't pay taxes. But they're still a good bet as far as being
sure,
a borrower and repaying their loans. So
sure. I know there's a couple different types of stated income. There's stated income verified asset, stated income stated asset, no income verified asset, and no income no asset. Which one of these four is this? Is this stated income verified asset?
so we're all the loans are stated income as far as we don't ask for any tax returns. We don't ask for any 12 month bank statements. We do offer stated loans to W-2 borrowers. We don't ask for their paychecks, or we don't even call and verify their job. Where we are, so all of them are set up like that. The only time we get into verifying assets are on a purchase. We do want to verify that the down payment money is coming from our borrower. So we like to get 3 months of bank statements to show, the down payment money is back from our borrower and they have it. Now we do offer an alternative to that, where we have a no seasoning program for the down payment money, where they just have to show one bank statement right before closing with the money in it. So as far as when it comes to assets, we don't verify do they have 401ks, do they have checking accounts. The only time we get into like wanting to see assets is just for down payment money, and we have some flexibility with that.
It's my understanding that you also will do foreign nationals too. Um,
Um,
is that correct?
we do. Our foreign national program, it's a little tougher to qualify than most. They have to have a green card or work visa. They have to have proof of an address in the United States. They have to have a social security number, and we need to be able to pull for lack of a better word, an American credit bureau on them. They have to have credit scores and trade lines. So our
Does
foreign
their
national program,
if it's
what's that?
a purchase, do their assets have to come from an American bank that you verify?
Um, typically, yes. Because a lot of times, if we can, without a doubt, prove that it came from one of their accounts overseas, we can accept that. But say, it's an Asian borrower and the bank statement is in, foreign language, and we have no one here that
Right,
can read that. That
right.
can be tough, right?
Okay. Well, that makes sense. That's fair. Um, let's talk about time, because one of the big things about stated income loans is, in theory, they're quick to approve and quick to close. How long does it really take to get approvals, and how long does it really take to get to close these loans? And I know the answer is not the same for different types of assets, but can you take a minute and talk about that?
Sure. To get a pre-approval on our deals, first of all, we need some basic information, a regular 1003, a credit report, and we get a pre-approval issued in 24 hours. Oftentimes it's the same day. It just depends how early in the day you can send it to us. Um, After pre-approval, from pre-approval to closing on a commercial deal, we're talking multifamily, mixed use, retail, office, warehouses, those type of properties. You're looking on average about 40 days. The reason why it takes 40 days is we have to get a complete summary appraisal on the property. It's a very thorough appraisal report, and they take, on average, about 3 weeks. So
Gotcha.
a lot of the time it's just eating up getting the appraisal.
Do you guys
Now,
normally use like a nationwide appraisal company or something like that, or what's the vetting process of using someone to do the appraisals?
so we have our own network of appraisers we use nationally.
Okay. And so I guess I can infer that the other type properties, specifically the 1 to 4 units for investment properties for single family homes and 2, 3, 4 units, those are faster.
Yes. So for that, we do use an appraisal management company. And the nice thing with those is we can use an appraisal in a residential format. So those appraisals can take, if we can get the appraiser in the property quickly, a week to 2 weeks. So that really saves us some time. And those on average run, 20 to 25 days to close those.
Okay. What would so in this process you issue a pre-approval letter? What can negate the pre-approval? I mean, obviously, an appraisal coming in short would
Right.
modify the terms. Do you pull it up front? They provide you a copy of their own tri-merge, correct?
Correct.
When do you actually pull? I mean, I know that the borrowers can pull their own tri-merge and submit it with you, but when do you guys actually pull their credit?
Sure. So we pull credit when the file goes into our processing department. So for the file to go into processing, we need our pre-approval package signed by the borrower. Depending on the deal, we need some additional paperwork filled out. But once it's mainly our pre-approval. Once that's signed and returned to us, we do need title. We need a title unless it's a purchase. Then I can move forward without having title. But if it's a refinance, we do want to have title on the front end. Well, so keep it simple. We'll just say, once I have title and our package signed by the borrower and sent back to us, I can then submit the file into our processing department. That's when we pull credit. So we like to do it then because we still haven't ordered an appraisal yet, but we're getting ready still. There are cases where, for whatever reason, the borrower's FICO score drops or they don't make a payment. So we want to try and pull credit. So in case there is some sort of credit score drop, they're not out the appraisal money.
Gotcha. Okay. I know a lot of lenders right before they end up closing, they might end up pulling credit again the day or two before closing. Do you guys do that?
No, well, it depends. So when we pull credit, whenever the file goes into our processing department, that credit is good for 45 days. So in most instances, we're closing within that 45-day window. But if we go past that, then we do have to pull credit again.
Gotcha. Okay, let's talk a little bit about cash outs. A lot of lenders don't like just giving you money. Explain the process of when you could use a cash out, and do you guys actually give them a check? I mean, how does that work with you guys?
Yeah, we cash out doesn't scare us. So whatever LTV they qualify for on the matrix and the commercial and the property debt services at that loan amount, we'll write them a big check. The only little caveat we have on the cash out is it can't be used for personal reasons because these are commercial loans, they're business loans. We don't. When we get our cash out letter, it can't be to pay for my son's college tuition.
Sure.
But that's an easy. That's a pretty easy thing. Cash out doesn't scare us.
Gotcha. Well, so let's say someone was applying and they wanted to make improvements to the property. Would they have to provide you bids from contractors or vendors or anything like that? Do they have to document that?
No, we don't babysit the cash out. So even if they want to do that's a great example. Or if someone wants to consolidate some business debt or whatever, we're not going to require that we pay the lenders on the HUD or anything like that. We're just going to give them the cash and they can do what they want with it.
Gotcha. Okay. A lot of banks once you get a loan, especially on commercial investment properties, every year you have to provide updated financials or pull credit, things like that. What's the process with you guys? Do they, in when it goes into the second year of the loan? Is there any of that, pulling credit, providing financials, anything like that?
No, so the only thing we expect you to, I guess, upkeep, and this is with any lender, would be, probably insurance on the property.
Of
But
course.
we do escrow for taxes and insurance. But as far as like, if someone make you sign a 4506 where they pull your tax returns in the future, we don't do that. We don't, quite frankly, we don't check on title. So after it closes, if something, I don't know, there's a change on title, we don't monitor that. There's once the deal closes, it's closed. There's no follow up.
Sure. Okay. Um, let's talk a bit about seller seconds because uh, I know that they're allowed, and I know that you guys want to see skin, at least if it's an acquisition, you want to see skin in the deal. Are seller seconds allowed? And if they are allowed, do they have to go on a standby? Can they receive payments? Does it depend on the deal? How does that work?
Yeah, it's a good question. We do allow seller seconds or seller carries. We allow them up to 80% CLTV. So whatever LTV we can be at, give it 70, 75. There are some LTV reductions for various reasons. Um, Wherever we're at LTV wise, we'll allow the seller to carry a second to make up any difference up to an 80% CLTV. We do expect them, the mortgage, so there should be payments being made at a market interest rate.
Okay.
That's what we like to see on those. The borrower has to have at least, like you said, 20% skin in the game. So minimum they need that 20% down. And we will allow a seller credit at closing.
Okay.
Purchase up to 3% only towards closing costs. We don't want a situation where they're getting $10,000 back in the payment.
Right. Now, so you said up to 3% seller credit, correct?
Yes.
Okay.
Exactly. Yes.
Okay. Um, let's say someone's purchasing an investment property. With your underwriting guidelines, do they have to have owned an investment property before to qualify? And if not, then how does that work? How does the underwriting work for that?
Sure. No, they don't. And quite frankly, someone could be a first time buyer. They may be renting and they want to buy a rental property, or they may have their house and they want to buy their first investment property. We will allow for that. But we do take a 5% LTV hit, though. It's just inherently more risky. But
Sure.
we'll allow it just at a 5% reduced LTV.
Okay. Um, how do how do people make their payments? Is it something that's set up through EFT, or they just get a bill each month, or how is that?
It's they can do either. So it's handled by our servicer. They can get a monthly statement in the mail, or they can go online like most banks these days. They go online and I believe create an account. They can sign up for an automatic debit out of their account monthly.
One more question that just occurred to me on your prepayments. If someone prepays a loan off early, I know that any type of private or anything well, whether it's institutional financing, they're going to want to somehow get their rate of return on their money, whether it's on the front end, back end, wherever. How does and I know you have different prepayment penalties based on how long the term is, but is it just the long and the short of it is, let's see, like I think you have one of your plans as a 3-year term, and I believe that the prepayment is 3%. Is that correct? For 3 years?
It is. So yeah,
So,
on the
go ahead.
on the 3-year arm, the prepay matches up to the fixed period. So if you take the 3-year fix, it's a 3-year prepay. Now, if it's a commercial loan, it's 5% of the principal balance for the first 3 years. If it's if it's a 1 to 4 family, the percentage is lower. It's 3% of the principal balance for the first 3 years.
Gotcha.
And on all of our loans, they can pay up to 20%. of a principal balance in
Mm-hmm.
any 12-month period without penalty.
Gotcha. Okay. So, but they don't. It's not like you're not adding 5 and 5 and 5. It's just 3% flat or 5% flat or whatever that amount is. Correct. It's not.
Exactly. It's
It's
just
not
for the first 3 years.
accumulation.
No,
Gotcha.
no, 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 nothing like that.
Okay. Well, you know, you never know because it's like with hard money. A lot of times they've got pretty strict exit fees because they're wanting to capture all of their interest, and so it can be onerous. So,
Yeah.
well, listen, I appreciate you spending time going over some of the highlights of uh, about stated income loans, or I should say stated income commercial, stated income investment loans, how it really differentiates from regular stated income loans for residential. Um, and I'm a firm believer that the more information you have, um, if you're speaking with someone and they're looking to do this type of financing, the more information you have up front, the more likely you can go through it and find out who has a legitimate transaction and who's just not going to fit in the box. And so I think this will help a lot. So I appreciate so much you taking the time to do this